Today we're going to answer the age-old question, rent versus buy. In the DC metro area, there are a number of tenants out there who want to buy property and would be buying property if they understood the financial consequences of renting for a long period of time. So for our scenario, let's assume you're renting a 2-bedroom, 2-bath condo in one of the desirable areas of either DC, Bethesda, Arlington. Pick your area, but rentals are fairly comparable as far as the pricing in those neighborhoods. So 2-bedroom, 2-bath, let's say you're paying $2,750 a month. That's roughly $33,000 a year on an annual basis with no tax advantage, and that's $33,000 you're paying after taxes. So now let's take that same property, 2-bedroom, 2-bath in downtown DC, Bethesda, Arlington, for purchase. Let's assume an average sales price of roughly $550,000 for a 2-bed, 2-bath condo. So what would my payment look like? Well, let's run an exercise on a 10% down conventional mortgage, which is very popular in today's market, and what the payment would be on that. Now remember, your rental payment was $2,750 a month, or $33,000 a year. So let's assume 10% down, interest rate of 3.5%, which is about market. In fact, some lenders are offering even an eighth of a point lower than that right now. 30-year amortization, and your loan amount would be $495,000. So what does that mean to me financially? Well, that would put your principal and interest payment at $2,222 a month. Plus your taxes annually, let's assume, are $350 a month. And then you have insurance, which would be $40 a month on average. That takes your total payment to $2,612 a month. So let's compare the two. You're renting for $2,750 a month, or you could own the same unit for $2,612 a month. The math makes sense. But let's take it one step further. Let's look at the tax implications of what it actually means to own real estate. I'm not going to get into the details of depreciation of your property as a real estate asset, but I will discuss your simple deductions that you can take every year just by being a homeowner, which include interest deduction and real estate taxes. So on our example that we're discussing today, at $550,000, your taxes of $350 a month are deductible, along with your interest deduction. On that purchase in particular, your first year interest deduction would be $17,173. So combined with your real estate taxes of $4,200 a year, that's $21,373 that you're able to deduct from your taxes on an annualized basis. So what does that mean? If you're in the 30% tax bracket, that's a savings of $6,412 directly off of taxes you would have otherwise paid as part of renting a property. So that $33,000 figure we discussed before is really $39,412 because you don't have that $6,000 deduction in your taxes. So when you break it down, you're paying $2,750 a month renting a 2-bedroom, 2-bath, or you could purchase a 2-bedroom, 2-bath at $550,000 with 10% down. Your mortgage payment would be less on a monthly basis by about $150, and annually you'd be paying roughly $7,000 less on an annualized basis with the tax advantages. What makes sense to you? I know you probably have additional questions, so feel free to contact me at scottsachs.com. I'd be happy to walk through the process, and we can run a specific analysis for your needs to see what makes sense. Thanks, and have a productive day.